I always say tariffs is the most beautiful word to me in the dictionary.
U.S. stocks are tumbling. Right now, the Dow is down about 900 points.
What a chaos during the Trump tariff era. Markets swinging like crazy, uncertainty everywhere. But guess what? Where there's volatility, there's opportunity. In this video, I'll break down how to trade smart when tariffs hit the headlines. But first, let's understand how tariff works. Based on Investopedia, tariffs are taxes imposed on imported goods. For example, in January 2018, the Trump administration imposed a 20% tariff on imported washing machines for the first 1.2 million units, targeting foreign brands like Samsung and LG. The goal? Protect U.S. manufacturers like Whirlpool, who had been lobbying for action against foreign price undercutting. According to a study by economists from the University of Chicago and the Federal Reserve, the average price of a washing machine in the U.S. rose by $86 in the following months. But here's the twist: dryer prices also increased by $92, even though they weren't subject to the tariffs. A classic case of bundled pricing behavior. All in all, it's estimated that U.S. consumers paid an extra $1.5 billion in total, and for every job created, it cost around $820,000 in added consumer costs. So while the tariffs aim to protect U.S. jobs, they also created inflationary pressure and higher costs for everyday Americans. So we've just covered what tariffs are, but now let's walk through the latest Trump tariff policies. Starting on February 1st, 2025, President Trump kicked things off by slapping a 25% tariff on goods from Mexico and Canada, along with a 10% tariff on Chinese imports, while there was a 30-day pause for North American partners after new border security promises. The pressure on China only ramped up. By March, steel and aluminum tariffs were raised to 25%, and new tariffs were approved for cars and auto parts. Then,
My fellow Americans, this is Liberation Day. April 2nd, 2025 will forever be remembered as the day we began to make America wealthy again.
what Trump called Liberation Day, when a universal 10% import tariff was rolled out, followed by a series of reciprocal tariffs targeting countries with high trade barriers or large trade surpluses, the U.S. Among the most impacted were China, facing an effective tariff rate of 54% after a 34% reciprocal tariff was added to an existing 20% levy. Vietnam, hit with a 46% tariff primarily on textiles, electronics, and footwear, and Cambodia, facing a 49% tariff on garments and low-cost consumer goods. In contrast, several countries face minimal reciprocal tariffs, either due to low trade barriers or aligned trade relations. Some countries like Australia, Singapore, the United Kingdom, and South American countries like Brazil and Argentina all remained at a flat 10% tariff. However, Trump suspends the country-specific reciprocal tariffs for all countries for 90 days except China. Interestingly, since President Trump was elected, U.S. tariffs on China surged from 20.1% in January to approximately 145% by April 10th, although carve-outs and exemptions on April 11th slightly reduced the average to 124.1%. Some product categories, particularly in technology and industrial goods, faced peak tariffs of up to 245%. These actions reflected Trump's aggressive approach to counter what he described as China's unfair trade practices, and they marked one of the most protectionist shifts in U.S. trade policy in recent history. So the question is, how to trade during trade war? The answer is very simple. It is gold. But first, let's rewind time. Throughout modern history, economic downturns have left deep scars on global markets. The Great Depression of the 1930s was triggered by the 1929 stock market crash and led to mass unemployment and a collapse in consumer confidence. In just 3 years, the Dow Jones Industrial Average plummeted from 381 to 41, a devastating 89% loss between 1930 and 1933, wiping out decades of growth. Decades later, the Great Recession of 2007 to 2009, caused by the housing and financial crisis, sent shockwaves through global banking systems and wiped out trillions in wealth. More recently, the COVID-19 recession in 2020 halted economic activity worldwide, leading to unprecedented stimulus and volatility. While each of these crises had different causes, one asset consistently gained strength: gold. During times of fear, uncertainty, and market instability, gold has historically surged as investors seek safety. Whether in the 1930s, 2008, or 2020, gold acted as a hedge against collapsing equities, inflation, and currency devaluation, reinforcing its reputation as a reliable store of value in the worst of times. So, we all know that we have to long gold. But how to do it? I have made many videos about this strategy already. It is called order block strategy. An order block is a critical concept in smart money trading strategies. It refers to a price zone where institutional traders like banks or hedge funds have placed large buy or sell orders, which cause a significant price movement. For high probability order block, first, price must sweep liquidity, meaning it should break above or below the previous candle's high or low before initiating a strong move. Second, price must leave behind an imbalance, a gap between consecutive candles indicating inefficient price movement. Without this imbalance, the identified order block may not be valid. Third, order blocks must be unmitigated, meaning they are most effective on the first retest. Once an order block is mitigated, it is no longer considered a reliable area for future trades. Fourth, a high-quality order block must lead to a break of structure or a change of character, confirming a shift in market direction. This strategy is very straightforward. Since we only take long positions on gold, our focus is solely on identifying bullish order blocks on the 15-minute time frame. Once we've marked the order block, we then drop down to the 1-minute time frame to look for a specific entry model known as the change of character. I highly recommend rewatching this video to fully grasp the concept and execution. For each trade, we place the stop loss just below the order block, and we target a 1-to-2 risk to reward ratio for profit. Let's apply the strategy on a real chart. This is the 15-minute gold chart from April 21st to April 22nd, 2025. We can see that the price has recently retested a bullish order block, which sets the stage for a potential long setup. Now, we drop down to the 1-minute time frame to refine our entry. At first, price shows a clear internal bearish trend, but then we observe a shift in structure, aligning with the higher time frame bullish bias. Shortly after, a breaker block forms in confluence with a fair value gap, a high probability entry zone. If you're unfamiliar with these concepts, I highly recommend rewatching this video for a full breakdown. We place our stop loss just below the breaker block and target a 1-to-2 risk to reward ratio. As expected, the trade plays out perfectly and price hits take profit, securing a solid 2% gain. Here's another trade setup on gold from the same day. Although price retested this order block, it had already been mitigated. However, price still respected a recent key level or support zone, making a long trade valid. We then drop down to the 1-minute time frame to fine-tune our entry. After a sudden drop, price shifts structure, leaving behind a fresh bullish order block. We place a buy limit order at this level, with the stop loss just below the block, and aim for a 1-to-2 risk to reward ratio. Fortunately, this trade also played out perfectly, giving us 2 wins in a row on the same day. Additionally, we spotted a potential re-entry opportunity off another clean order block. It presented a strong setup, but remember, always reduce your risk before entering a re-entry trade to manage exposure and protect your gains. And that wraps up our deep dive into how markets have reacted to major global crises and why gold continues to shine in times of uncertainty. By the way, I've just launched a free Discord community where you're welcome to chat about trading, economics, or politics in general, so be sure to check out the link in the description below. If you found this video helpful, don't forget to hit that like button, subscribe, and turn on the notification bell so you never miss future insights into global markets and investing strategies. Until next time, stay sharp, stay curious, and as always, trade smart.